Welcome back, everyone. This is Salt Talks. My name is 𝐲𝐿𝐿, partner at SkyBridge Capital, global multi-asset class alternative investments firm, and increasingly these days focused on crypto. Salt Talks is a series of digital interviews with the world's foremost investors, creators, and thinkers. Just as we do with our global SALT events in person, we aim to both empower big, important ideas and provide our audience with a window into the minds of subject matter experts. We have a great one today and excited to welcome Mike Cahill to SALT Talks. Mike is a director of the Pyth Data Association, which is the Swiss association behind the Pyth Network, the decentralized Oracle solution that brings financial data across asset classes on-chain directly from the source. May sound a little jargony to you guys, but that's why we're here. We're going to dive into it. Mike comes to us from Porto, where he's also the head of European business development for digital assets at Jump Crypto, which is involved with Pyth and is one of the market data providers. Prior to joining Jump and Pyth, Mike spent more than 2 years at 𝐲𝐵OE. Before that, he was the global head of FX sales at �KCG in New York for a number of years. And also had a stint at Nomura as head of FX sales there. So, Mike, thanks for joining us. Why don't you start off with a minute or two on yourself beyond just the quick bio I gave, and more importantly, how you got into crypto, how you got involved with Pyth.
Cool. Thanks, Jason. Great to be here. So, yeah, you did your research. So you've got like I think the high level down. So traditional finance background. I worked at Morgan Stanley out of college in FX sales and trading. The business was profitable. It was a pretty desirable place to work. But it wasn't really difficult to conclude that there was like tons of inefficiencies. So I moved into algorithmic trading because this was like a transition that had already happened with equities. It happened with futures. It was most likely going to occur in the FX markets. And so I got into the FX automated trading business at Morgan Stanley, and that's where I made these jumps to the other firms that you mentioned. So KCG is one of the largest, or was at the time one of the largest trading firms, specializing in U.S. equities. It's now a part of the part of Virtu, which was part of an acquisition that happened in 2017. So basically, it was kind of seeing the direction of travel for the traditional markets, more automation, more specialization and expertise. And I continued to kind of gravitate towards the areas of innovation there. So in 2017, Virtu had announced an acquisition for KCG. Whenever this happens, it's like pencils down, pause all your work, sort of an event. And it was 2017, so you had this ICO boom and you had a big crypto bull market. So it was a great time for me to like really dive into the crypto market. And so that's really what I did. Me and a couple of other traders went very deep, read a lot of white papers, got very involved, signed up to a whole bunch of exchanges. And that was what led me down the path of getting involved in crypto. And then I joined Jump in 2019, and I've been there for 3 years. In 2021, and as you said, I'm running the business development, which really we think about as like our partnerships. So in 2021, Pyth became one of Jump Crypto's largest partnerships. And so I joined the Pyth Data Association on the board of directors, and I've been pretty much exclusively focused on Pyth ever since.
Terrific. So you come at this from a traditional finance background, as do I and many of my colleagues at SkyBridge. Two of the words that stuck out to me, innovation and inefficiency, which you mentioned, I think is what really summarizes why many of us are so excited about crypto. So it seems like that was kind of your evolution. And then with the acquisition, you were sort of forced into it and everything came together. And now here you are, one of the leading crypto firms. Let's dive into Pyth. Give us the high level of what it is, why people should know about it. Obviously, it's essentially cross-chain data, but give us the dirty details and maybe touch on how it compares or contrasts to something like Chainlink.
Yep, great question. So the high level of why you would need an oracle is broken down into Bitcoin is, in the simplest form, a standard ledger that keeps track of the value of Bitcoin, right? And so it's pretty easy to get your head around. Think about a spreadsheet, and it's just like, right now Mike owns 1 Bitcoin. I send it to Jason. Own 1 Bitcoin.
I'll take it.
Yeah, would have taken it last week, probably even better. And Ethereum gives you the ability to basically write smart contracts on top of that. So if certain conditions are met, values of the ledger will be updated appropriately. And then everything that has come past Ethereum as other layer ones or some version of that have got a variety of different specializations. Could be that they're faster block times and lower gas and so on. So if you're building an application that is meant to run autonomously and be able to dictate where coins are going to end up on a ledger, you are largely going to be constrained to using the information that's embedded in that single smart contract application, or using some kind of trustworthy reference data, right? So the simplest application would be, I don't need to look at any reference data. I just need to look at the values that are in this smart contract. So you can think about an AMM, the simplest version of an AMM, automated market maker, where you've got like a balance of tokens on either side, and you're using a very simple formula to determine what the conversion rate is for a new token to be added to that pool. Everything else that you want to build, any interesting application that's going to either be a lending protocol or allow you to do some kind of trading that isn't as simple and formulaic as that, will require some input of reference data. And then as soon as you start using reference data on blockchains, the stakes go up immeasurably higher than when you do it on like the internet. Because now you're actually, that value that you're using as your reference data point is going to meet a certain set of criteria, and that criteria is now going to move something of value. If you're just using, say, like Yahoo Finance, Yahoo Finance is a website, could go down, could have bad information. The stakes are very low with regards to them like having bad information. If they've got bad information, it's a mild inconvenience to users, but it doesn't actually move anything of value. In the blockchain world, it doesn't work like this. If the value of this reference data is incorrect, something can transact. So like if you want to take a very simple example, we bet on the outcome of a basketball game. I bet that the Knicks are going to win. You bet that they're going to lose. We put some amount of Ethereum into a smart contract. And then at the end of the game, if the Knicks win and I get the amount that we put in an escrow, then we would have to rely on someone to say which team won the game. That's effectively the oracle problem. If I tell them, if I'm the one that's providing the data, I'm going to be biased to say that the Knicks won. If you're providing the data, you're going to be biased to say they lost. So we have to come up with some trustworthy source. So this is the oracle problem, very largely kind of explained. And the way that Pyth constructs a solution to this is to take data directly from data owners and provide it in the most streamlined way on chain. That includes a distribution for interpretation of a price as well as a confidence band, and has some elements of staking to it. So it's sounds relatively complex, but if you break it down, it's pretty straightforward. So you've got first party data sources. And so the first party data sources, you think about like you think about like the ways in which digital music was first brought onto the internet, right? In like the late 90s, you basically had like the big record labels didn't think about digital music as being an existential threat. And so people were able to take CDs, rip them, put them on a Napster, and then make them available. And that lasted until like the early 2000s. And then, Napster was sued into oblivion. And then there was also just all this kind of spam that was coming out. That's like using third-party data, right? So they don't have any effective stakes in the system. They're not part of the economic chain. The way that data has been distributed is like it's kind of taken or screen scraped. That's the model that's been used up till today for data oracle. So when you mentioned like Chainlink, that's the model that they will use to take. It's taking data from internet websites like Yahoo Finance or CoinMarketCap or CoinGecko and make them available to the blockchains. So when we were thinking about this problem, we realized, well, that is only going to scale so much. At a certain point, you're going to face the same problems that Napster faced with digital music. And the solution that ended up working more long-term and scaling was a Spotify solution, which was you bring in the owners of the IP, you have them distribute it, and you have them benefit from the economic chain. And Pyth does the exact same thing where it's anyone who owns data that is of a high caliber and high quality. So in our case, we're talking about financial market data, which typically comes from trading firms who send in bids and offers to exchanges and then trade with one another. And those trade executions can constitute what we would consider market data. So bids and offers and executions. And so what Pyth does is it attracts the largest trading firms in the world to publish the data that they own, as well as other exchanges, directly on chain in a way that can be combined to have an output that is a average price or the aggregate price, along with some uncertainty index that represents what the dispersion is of disagreements around a certain price. So yeah, I'll pause there and see where.
That's helpful. It's always good to bring in, familiar analogies like Napster. So that's helpful, I think, for our listeners. It sounds to me like some of the key principles here are really speed and accuracy in delivering the data. Speak to that. How you create a level of trust that you are delivering accurate data in a very fast manner to the end users of your data?
Yeah, great question. So the way that the Pyth network is set up is the data providers will publish the price and there's these confidence bands directly onto the Solana blockchain. And the reason why Solana was chosen as a layer one is there's a design decision to be made, which is you can build this in a customized way that is going to be as fast as humanly possible and have the cheapest gas, but only be built to process the Pyth network. Or you can use one of the existing layer one, like adaptable layer ones with a runtime. And the idea for Pyth was always to be cross-chain, right? It was never to be just a Solana Oracle. We believe that if you're a decentralized app building on any particular layer one, you should be able to get the best data. And this is the solution to be able to get that. So if you're like, here's another kind of quirky analogy. Like if we're in like the land of where everyone's using like a horse and buggy and you've developed an internal combustion engine, but you've covered it up. The likelihood that people are not going to believe that there's a horse underneath what you've covered up is very low. So what you need to do is expose like the pistons and the turbines and things so that people can say, all right, this is how it works. It's, kind of moving up and down like this. So we decided that we needed to do this out in a public way where people could easily audit the provenance of what was being represented. And so Solana ended up being the logical choice because when you stack up all the available layer ones that you wanted to be represented on, you end up very quickly deciding that it's going to be the one with the cheapest gas cost and the fastest block time. If you have anything other than the fastest block time, as algorithmic traders, are all well aware, you've got information asymmetry, you're going to be at a disadvantage to somebody who comes up with a price that ticks a little bit faster. So we need to be kind of the fastest one to be future-proof to a solution that could be faster and do so in a way where you can then distribute to all other blockchains at their fastest speed. So it's pretty easy to do this on Solana. So right now, there's an application that lives in Solana that's the Pyth aggregation. Data providers publish directly to this application, and it's fully transparent. It's, time to tick is immediate from the time that the publisher is streaming the price There's no middleman aggregators that are taking time to collect and redistribute that information. And it's being aggregated at the Solana block time, which is every 400 milliseconds. From there, it's distributed to other blockchains who will all have slower block times. And what's cool about this is there's a website, Pyth Network, where you can look into transparently who's contributing the price for a variety of symbols. But you could also, let's say that you wanted to go and validate this outside of something that's public like Pyth, right? Because that's one of the things within blockchains is kind of this trust but verify. So you wanted to verify this independently. All you need to know is how to use the Solana Block Explorer, which is something that's used for not just Pyth, but every other Solana application that's out there. And so you can go and click on the accounts, pull them up in the Block Explorer, and you can verify the provenance of the aggregation based on the fact that we said, hey, there's 32 data providers that are contributing to this Bitcoin price. Here's how you see them. And so that was really important. So this element of transparency, but being on the fastest possible blockchain was like the early design decisions and making sure that there was nothing cutting into that path of distribution from the publisher right onto the blockchain.
So it sounds like you guys gravitated towards Solana, as many do, because of the speed and the low cost. Obviously, as we know, with any blockchain or with any layer one, there's trade-offs. And one of the well-known trade-offs for Solana is that sometimes it does go down. How big of an issue is that for you guys? How are you able to navigate that?
Yeah, it's an important point. So within the rollout of Pyth today, we're currently live on Solana in mainnet and on a number of other blockchains only in DevNet. This works okay for that composition, but would be a limitation if we were to be live on the other layer ones in mainnet. And the reason why it works okay is right now Pyth is incredibly dominant on the Solana blockchain in terms of Oracle usage. I'd say greater than 90% of the applications that use an Oracle use Pyth for Solana. And so when there's a problem with Solana, it's affecting them as much as it's affecting Pyth. When you start getting into other layer ones, like Binance Chain being one that Pyth has announced it's currently in the DevNet environment with and applications are testing, that's not acceptable to have any downtime. So what we're doing is working on a redundancy such that it will be live by the time that we're moving into mainnet for those chains. It will meet the same criteria as the things that I described for the design decisions of choosing Solana, but will be sufficiently independent such that if Solana goes down, then this will be able to be a sufficient backup.
Got it. No, that's interesting. So as far as the actual publishers, you mentioned, Jump is obviously one, but there are other trading firms and financial firms. How do you get them involved? What's the incentive for them to participate with their data?
Yeah. So there's over 60 today, and I'd say there's almost no large trading firms that are missing from Pyth Network, and it's becoming more and more the case with exchanges as well. So Jane Street, Susquehanna, DRW, Virtue, et cetera. The way that they see this is in a couple of ways. So the first thing is it's almost a found resource for most of these firms. About 10 years ago, the large exchanges and traditional financial markets made a diversification of their revenue streams where they introduced market data fees in addition to the execution fees. And over this 10-year period, the market data fees have become astronomical to the tune of like $5 to $10 billion a year for real-time data for traditional assets. And if you're a big trading firm, you're on one side of that ledger. You are just buying the data. And what Pyth does is it gives really for the first time the ability for large firms who have tremendous troves of data to be able to contribute and now actually be on the other side, on the supply side of those economics. And so that's a really cool factor we understand that the market data business is this $5 to $10 billion a year in traditional markets, right? Different types of data requirements in those markets versus crypto, but there's a value to this. And for Jump or Jane Street or Susquehanna to be able to contribute to this, grow an ecosystem of Web3 that we fundamentally believe in and we want to participate in, and we can help shape in terms of making sure that the tools are fair and accessible for the various builders, is a really important function, right? So this is like a kind of found resource, almost a sunk cost where we had never been using it before, and now we get to monetize it. So the way that Pyth allows data providers like us to monetize is through data staking, a proof of stake layer one validator setup, which is an energy efficient way to use game theory to keep people honest, is pretty easy to understand and easy to apply to Pyth for data providers. So in like your standard layer one setup, you'll have a number of validators and they'll have to post some stakes so long as they're being honest, which you'd figure out through this 𝐸𝐿𝐫𝐫 coefficient. As long as they're being honest, they earn rewards. If they're being dishonest, their stake is slashed. If you apply those same principles to Pyth, data providers, so long as you're sufficiently decentralized, and there's over 60 data providers today, data providers that provide accurate information get rewarded after they've posted some stake, and those that are inaccurate or incorrect are subsequently slashed. And so we're incentivized both positively and negatively, but ultimately we get a bet on ourselves as data providers and the quality of our data. If we bet that the quality of our data is going to be useful, we think it will earn rewards for it. That's really the primary goal.
So there obviously is some financial incentive via the staking mechanism, but I think what you're also saying is that there's this, because we're talking about firms here that might otherwise be rivals and might not necessarily collaborate with one another. But as with many things in crypto, it does sound like there is this collaboration component to it. Everyone working to grow the ecosystem and the various use cases involved there. Talk to me on the other side, the users of the data. Are these trading firms also big users of the data? Are they writing trading strategies, or give us a few examples, one or two examples of who's actually using the data on the other side?
Yeah, sure. So the data users are application builders. And so I'll give you the most standard application to help kind of crystallize the usage. A lending protocol, something similar to Compound, say SolLend on Solana, will allow you to deposit an asset and then take a loan out in another asset. And the use case for that is, I don't really want to sell my Solana right now, but if I had access to this other token, I could be using it in an application that I want to experiment with. And the way that these applications generally work is you'll have a collateralization level that will have a appropriate liquidation amount, and you'll post that collateral, and the application will basically need to keep track of where your liquidation level is. And so if you've posted $1,000 worth of Solana and you had a liquidation level at let's say $500, if the value of your Solana reaches $500, you'd be liquidated versus what you've taken out as a loan. Finding out what the value of your collateral is and converting that into dollars is a job of an oracle. And so that's where Pyth would be sending in prices, and the application would be effectively looking at the values of the various types of collateral that they've borrowed or the types of assets that they've allowed people to lend out. And so that's where Pyth is being used. Back to your point about like the collaboration efforts, I think you totally nailed it. The way that Jump, Jane Street, and all these other firms think about this is we're going to go build an arena together where we can compete with each other at some point in the future. So right now it's let's go, this is certainly not zero sum. This is absolutely positive sum. We're so incredibly early. We have the opportunity to make even more interesting ways for us to compete. And all we need to do is, build that infrastructure together, which we know that no one else can really do it on their own. So we have to kind of work together to do this. And then we'll go and fight each other to the death.
Yeah, completely agree. I think it's an interesting dynamic that most people not deep into the space are aware of, because you have these big name rival firms on Wall Street, which is notoriously cutthroat. Yet when you look underneath the hood, there's a lot of collaboration going on. We think of it as, to your point, being so early, we're all growing the pie. We can rip each other's heads off later. And I'm sure that time will come. We have a couple minutes left. I want to touch on the progress that you guys have made in a seemingly short amount of time. You launched just last summer. Obviously, everything in crypto moves very quickly. Give us a sense of the progress you've made in this short period of time and where you think you're headed, what some of the immediate priorities are this year and next year.
Yeah. So we launched on Solana, and as I said, we've gotten to greater than 90% of applications that are using Oracle are using Pyth. So incredibly dominant on that chain. We've achieved over 60 data providers and are on a trajectory to hit 100 before the end of the year, which we think we'll hit. The next obvious expansion for Pyth is other chains. So I mentioned that having this redundancy layer, which will allow Pyth to leverage an interoperability protocol called Wormhole to send transactions or messages from Pyth to other chains so they can be used in a lending protocol, say on Binance chain, is what we're focused on. So for this year, we want to continue to increase the scope of the chains that Pyth is working on and available on, increase the number of symbols that are supported so that more applications can use them, and continue to make the offering more robust, so more data providers and more symbols and so on. There's a number of features within the Pyth white paper that will also be added. So that data staking that I mentioned will be rolled out in its first form. So there's a lot of stuff going on, and really just expansion, which we're super excited about.
How big is the team? And I asked that in the context of a lot of job cuts across the industry. Coinbase just announcing this morning. How big is the team? How do you guys deal with what is becoming a very difficult economic environment, the potential crypto winter ahead? Does it impact you? Does it create opportunity? Do you keep your heads down and ignore it? Give us some insight there.
We're about 30 people today. We plan to hire another 10 or so, focus on Pyth. We haven't changed those numbers in the last few weeks materially. We're going to continue to be really opportunistic. So when we see layoffs, we do think about that as an opportunity to hire some really good people. In terms of like what's going on with the greater market environment, we think it's a good opportunity for us to, build without distractions, to continue to focus on really high quality projects and partners, which I think is something that people tend to deviate from when there's too much money in the system, because you can often like buy your way out of earning the organic growth. And we think that we'll be able to earn this organic growth by like finding really strong partners, getting them to understand the value contributions of Pyth and the differentiations of having first-party data and confidence bands. So yeah, we think it's a great opportunity for us to continue to grow. Obviously, no one likes the fact that the market environment is the way it is, but we're really focused on just kind of executing.
And you guys, I'm sure, have interesting insight into the development activity on Solana and elsewhere. Have you seen a slowdown or a change given the drop in price and just a lot of the noise, or is there still robust development activity going on with these blockchains?
Yeah, we still see a lot of robust activity in development. I would say that the place, there's always going to be a lag, right? So the place where you would end up missing out on the development is someone who's gone out of incubation and into like, hey, I need to raise money to scale. Like they're probably going to struggle the most right now. If you're either in incubation and you wanted to experiment and throw a bit of spaghetti against the wall, like you're still going to be super active. And we see tons of projects that look like that. or if you've already got over the funding hurdle and you have enough of a balance sheet to be able to cover you for your burn rate for several months or years that could take for this bear market to turn. And then you're obviously very focused as well. So we haven't really seen a delay. We haven't seen a lot of people who are like kind of hanging things up. But I do think that like it'll manifest itself in that sort of middle category if it does happen.
Makes sense. We're likewise seeing similar in the areas that we focus on. So we'll finish up here. Mike, I want to summarize in my own words and maybe for our audience how I think of Pyth, and you can tell me if it's right or wrong. To me, to put it in sort of Web 2 terms, is you guys are really building decentralized or Web 3 or crypto version of Plaid, which is a big infrastructure player in fintech that connects the data providers, the financial institutions where all consumer data is held, to the leading fintech companies that have been building these amazing consumer products. Is that fair? Is that a fair way to think about what you guys are doing?
Absolutely, yeah. Yeah, we use I sometimes use a more abstract analogy, but I think yours is probably more spot on, where it's like we like to think of ourselves as like a GPS that enables the Ubers and other applications to be built. So we're really trying to pave the way for all kinds of both winners and losers of like the bed of DeFi and Web3 to be able to use the best possible tools that are out there.
Great. So we'll finish up here, Mike. If let the audience know resources that they can go to learn more. You mentioned a white paper. Where would you direct people to learn more about Pyth, or if they want to get involved, how should they reach out to you?
Yeah, go to Pyth.network, the website, and you'll find all of our links there. We're pretty active on most of the socials, so Twitter, Discord, Telegram. Reach out in the Discord, and someone will be able to get in touch and give you guys some more information.
Terrific. With that, we'll finish up here. Thanks everyone for joining Salt Talks. Thanks to our guest, Mike Cahill of Pyth Data.
Thanks so much. Thanks, Jason.